difference between data moving at the speed of light and moving at the speed of matter, all the abstractions that we've developed to solve that problem ended up pushing money itself into becoming an IOU. And that's the problem. We all know this is fundamentally an unstable system. You see it periodically with the 2008 financial crisis, with the repo market disruptions, and just recently this year with several bank failures. I believe more of those are coming. Interest rates can't be as high as they are right now, with investment portfolios of a lot of banks being so far underwater without more failures coming. But that's the point. When the entire financial system is layers of IOUs pyramided on top of IOUs, it's fundamentally unstable.
Welcome to the Rose Show podcast. Welcome to the Rose Show, your ultimate independent source for achieving true wealth. Today, I speak with a true woman pioneer in business, finance, and banking, Caitlin Long. She is founder and CEO of Custodia Bank. All the benefits of being a bank, along with expertise in digital assets. They are designed to be the bridge between digital assets and the traditional financial system. Does not come without challenges, as they are fighting with a lawsuit with the Fed for being denied a master account. Today, we're going to talk about that lawsuit, as well as what's going on in the banking industry and the money system. We delve deep into the traditional banking system, money, Bitcoin, and the future of banking. Data moves at the speed of light. Shouldn't your money, their IOUs, isn't there counterparty risk and settlement risk? I think it's important that everyone learn more about your money. So stay tuned, enjoy the show, subscribe to the channel, enable notifications to stay ahead of all the latest. Thanks and enjoy the show. Thank you so much for joining us today. I have the highest honor of being here with an amazing woman in finance, Bitcoin, banking, Caitlin Long.
Oh my gosh, thank you.
You're welcome. You're awesome. 22-year plus vet of Wall Street and active in Bitcoin and blockchain since 2012. You are a true pioneer. Wow. And you are founder and CEO at Custodia Bank, banking of the future. You have all the benefits of a bank with expertise in digital assets and formed to be compliant bridge between digital assets and traditional financial system. Much needed. So grateful to have you here today. How you doing over there in Wyoming, Caitlin?
Doing great. It's great to be in Wyoming, which is where I grew up. So it was fun to come back home from New York.
Absolutely. I love Wyoming. It's so beautiful there. And I want to give you a congrats on your Distinguished Alumni Award at University of Wyoming. I love the pictures. I love those horses. I love the horses in your background right there too. Do you ride horses?
No, not really. I mean, I have many times, but I'm not a rancher. So just there are certain things you do growing up in Wyoming. Of course, you go horseback riding. I was taught to shoot a rifle in 8th grade in the public school. There's certain things exactly in hunter safety, right? It's a hunting culture, but not everyone does all of those things regularly. So yeah.
Wow, so cool. Great life over there. So I want to begin with you sharing with us your journey to Bitcoin and in founding a real bank, Custodia Bank. Tell us how it all began, please.
Well, I came into Bitcoin through alternative schools of economic thought after the 2008 financial crisis. I didn't come across Bitcoin until 2012, and it was through the Austrian school circles. It was actually Jeffrey Tucker wrote a private newsletter in February 2013 that caused me to really dig for the first time, because like so many people, when you first come across Bitcoin, you don't really believe it. and I was skeptical, as most are in the beginning, and then went down that rabbit hole deeply in 2013 and never came back out.
Wow. Well, that's how it works when you disrupt industries. And Bitcoin is a money disruptor, and it's a disruptor in many ways, socially, it's economic energy. And I love Michael Saylor calls it that. It's economic energy in the purest sense. So you wrote this amazing article. I just read it last night, The Engineering of Bitcoin. So please take that and tell us what Bitcoin is to you.
Well, it solves a problem I've spent a lot of time working on in Wall Street, which is the settlement mismatch problem. There are enormous resources dedicated to solving the fact that the sender and receiver legs of a transaction don't settle at the same time. When you send money on Venmo to split a dinner check, for example, it shows up almost immediately in each other's accounts that a transaction happened. That's just the data leg of the transaction. But behind the scenes, the money leg is going to settle probably in 1 to 3 days. You see this with stock transactions, that the data leg goes near instantaneously at the speed of light, but the actual settlement of the trade is 2 days later. And Lynn Alden really helped me see that. I've been talking about settlement risk for years because I saw so many problems, that there were so many nefarious, but also just inefficient things that were taking place in the financial system due to the fact that transactions settle a day or two later than the transaction date. There are a lot of people who make a lot of money in that time frame. But Lynn Alden expressed it in engineering terms, and she connected a very, very interesting dot for me, which is, since the middle of the 19th century, when intercontinental telecommunications channels were developed and deployed, we've been able to move data at the speed of light, starting with Morse code, very simple data structures. But we have not been able to move money at the speed of light. And money was back then physical gold. And we started to develop in the financial system abstractions because there were more transactions than could settle the physical money leg of a transaction. And so the first abstraction was, well, let's not move the actual gold. Let's just move an IOU to that gold, a warehouse receipt exchangeable for that gold. And then it became, well, no, let's have money eventually just be an IOU to an IOU, which is where it is today. And over the ensuing 170 years, we've developed further and further abstractions. And here's the punchline. What Lynn helped me realize in physics terms is that the difference between data moving at the speed of light and moving at the speed of matter, all the abstractions that we've developed to solve that problem ended up pushing money itself into becoming an IOU. And that's the problem. We all know this is fundamentally an unstable system. You see it periodically with the 2008 financial crisis, with the repo market disruptions, and just recently this year with several bank failures. I believe more of those are coming. Interest rates can't be as high as they are right now, with investment portfolios of a lot of banks being so far underwater without more failures coming. But that's the point. When the entire financial system is layers of IOUs pyramided on top of IOUs, it's fundamentally unstable. And so while it might appear that the US dollar is relatively stable today versus other fiat currencies especially, it's not going to remain that way. All fiat currencies ultimately fail in history, and the US dollar will too. We just don't know when. And in those lines, I'll wrap up by recommending a book written by a British historian in the 1970s called When Money Dies. It was written by Ferguson, I believe Adam Ferguson, When Money Dies. And it talks about the hyperinflation in Germany and Hungary after World War I. And ultimately, what I took away for the lesson for today is that when you have high inflation, that you start to have financial crises of increasing frequency and increasing amplitude. And there are also a number of head fakes. It's not, we tend to look at the hyperinflations on log scales, and it just looks like, a curve going straight up, and not straight up, but curved up and to the right at an exponential scale. But if you look at it in discrete time periods, it actually looks more like this as opposed to just, a relatively smooth curve. And that's because there are enormous head fakes that happen. And when the currency in Germany finally collapsed in its final hyperinflation, you saw 50% intraday corrections in the currency versus gold and in the currency versus stocks. And that was the big lesson of reading that book for me. Great human suffering, but increasing the signposts you need to look out for that the system is dying are increasing frequency and increasing amplitude of financial crises.
Excellent. So many excellent points there. Wow. I love that. It's an unfortunate truth, and it's just a matter of when. The fiat system is built on credit. It's these IOUs. It goes back to grade school. Remember on paper, you used to write IOU and used to pass it out. It's really no different. And I know people say, oh, it's backed by the government, but what does that really mean? They're spending to no end. The debt is unsustainable. And people need to realize it's the taxpayers, it's the people that are going to have to pay for that. It's a future burden against us, and it's unsustainable. So many great people like Greg Foss talks about this all the time, about the giant fiat Ponzi scheme. I had Jose Lemu, the Lightning Network, IBEX Pay on here recently, and he said that the money system and the way you transfer money is so archaic.
Yes.
We have data transferring at the speed of light, but the money takes days to clear. There is
even today.
Exactly. Yes. There is inherent risk. It's called settlement risk, I believe. And it's unsustainable. We need to have, in our internet age, we need to combine that technology with these economic incentives that Bitcoin so beautifully does. And it transfers money at the speed of light. Correct. Much needed. And we have inflation, currency devaluation just continuing, and it's hard to see. And I love that point that you made, how at first you're in disbelief. And that's how it works. That's how disruptors work. First, you're like, this is too good to be true. This can't be possible. But then when you dig a little deeper, and I urge everyone, the audience, to dig a little deeper. And just like Dennis Porter says, we tell you not what to think, but do your own research, and you'll see for yourself. Right. So excellent points there. I urge everyone to read your amazing article, The Engineering of Bitcoin. So beautifully written. You're a great writer as well, Caitlin. I love it. You're welcome. So Bitcoin, the beauty of it is that in time it grows stronger. It actually becomes more decentralized and attack resistant. Just so beautiful. So my question to you is, how big do you think Bitcoin will eventually get once it becomes money?
Well, the security of the network is what matters most. Now, I recognize that the use of money is the application of it. That's the use case. But what I find fascinating is that because the block size war was won by the folks who favor decentralization and keeping node requirements as lightweight as possible so that the network can be run by individuals, that when you can run a Bitcoin node on a phone and you have 8 billion people who can run a Bitcoin node on a phone, that's nirvana. I think the network is unstoppable right now. It's certainly got attack vectors that we can talk about in a moment. But again, I'll credit Lynn Alden. She's an engineer. She sees things in a different way, kind of like Michael Saylor. I liked when both of them arrived on the scene because they look at things a little bit differently and express them in physics and math and engineering terms. And Lynn points out that you can run a Bitcoin node on an old laptop with standard internet bandwidth right now. And as the storage and processing and bandwidth requirements to run a node are growing at less than storage and bandwidth and computer processing power generally are growing, what that means is it's becoming easier and easier and more accessible for anybody to run a Bitcoin node. So right now you have to run it on a laptop, but when we can start running Bitcoin nodes on a phone and 8 billion people in the world can do it, then this thing becomes really unstoppable. And it gets to Seyfedine Amos's point, he and I had an interesting podcast we recorded a few years ago where we were talking about, does this fiat system end with a whimper or a bang? And we both agreed it's likely to end with a whimper. We hope it does, actually. We hope it ends with people just voting with their feet to go to the better technology that we recognize is going to take time. And so those of us who are building these compliant bridges are really important ecosystem players right now. We won't be forever, because eventually people who will have crossed the bridge and not needed to cross back. But ultimately, it's getting to the point where you can run a Bitcoin node on a phone. And I think the Lightning Network, most folks will end up running Lightning nodes on their phone as well, because that's how you pay for a cup of coffee. Whereas I think base layer Bitcoin, rightfully so, is evolving into the FedWire equivalent of the US dollar system. It's the high value transfer system that costs more money to move but settles fast. Whereas the Lightning Network is low value, high frequency payments network, and it's a second layer network built on top of Bitcoin. I'm a huge fan of both of those.
Absolutely. Excellent points there. Again, the smartphone, the note on a smartphone, it's just a matter of time. Remember when we were back in high school, if anyone told us that a computer would be on a tiny little, I would never believe it. Yeah. I would be like, there's no way a computer, my smartphone could do everything I need. And so now, what it seems unlikely or even impossible, it will happen. Anything's possible. Absolutely. We just got to think systemically. And I love another article you wrote about that. And what you said about Lynn Alden and Michael Saylor, they apply that engineering mindset, that engineering approach. And that's how we actually live life, isn't all these different multi-levels. We need to think outside of boundaries, and we need to think differently. And that's how we come up with solutions to our challenges. I always think of challenges as bringing opportunities, and that's what we're in right now. We're in an opportunity to be better, to improve our lives. And Safadine was also on this podcast, and I have to watch your podcast with him. Sounds amazing. Timeless, because exactly what you said, we're hoping, he said the same thing on this podcast. Yeah. We're hoping that fiat will coexist with Bitcoin. Many will prefer Bitcoin, of course, but we are hopeful that it doesn't collapse. We don't want this big bang of fiat collapsing. Rather, people will just, like you said, move with their feet, move over, and understand that in this age that we're in, we need something that's economic engineering, that's here, that can transfer payments lightning speed and provide a solution to our current challenges. And fiat changes our thinking. We've become a consumering society, a consumerist, instead of saving, because it incentivizes short-termism over long-termism. We're not incentivized to save. With Bitcoin, on the other hand, you have that incentive to save, because you know that 21 million is a finite supply. But with fiat, you just know they're going to be printing again, QE infinity, and it's just going to keep getting devalued. So you just want to spend because it's going to lose its value. It's interesting how it just changes our thinking. So I want to talk about this amazing real bank that you created. You're a pioneer. So admire you, Caitlin. Custodia Bank. It's a tech-forward, customer-centric, and risk-aware, important terms, much needed in the financial system. Please tell us about your mission and your goals.
Well, we set out in the state of Wyoming, we the royal we, to solve a problem that a lot of entrepreneurs from the digital asset industry expressed back in 2017 and 2018, which is that they lost their bank accounts due to banks debanking them for various reasons. Now, one of the things about the way the bank regulations work is the banks can't tell you why they're closing your account by law. And so a lot of folks get very angry at banks, but in fact, it's the federal law they should be angry at. But we know why it was happening. There was risk aversion to and pressure behind the scenes by federal bank regulators on the banks for the reputation risk of banking this industry. And there were a couple of banks that decided to specialize. After the the first Operation Choke Point during the Obama administration, which started with payday lenders and expanded to 30 different industries. That was an effort by federal bank regulators to abuse their power to pressure the banks to stop banking industries that it didn't like. Payday lenders, adult entertainment, firearms, gaming, you name it. 30 different industries, okay? And we started to see that happening with the digital asset industry in that time frame of 2017, 2018, after the last bull market, the one prior to this past one. So Wyoming set about to try to solve that problem. And it's literally that simple. How do we keep durable banking, US dollar banking services for this industry? And we're in the middle of Operation Choke Point 2.0, which the Biden White House has directed. And it was an attempt to kill the entire industry. I do believe, because I've talked to various insiders, that the group that instigated this thought they would literally push crypto to zero. They thought that there was nothing behind it, and that if they popped the leverage bubble, it would go to zero. Now, in a lot of the 25,000 cryptocurrencies that exist today, they're worth zero, and they will go to zero if they're not there yet. But there will be some that break through, and we all understand that Bitcoin was never going to zero. And yet, I think, I know that I've been told that those who instigated this thought that it would. Now that it hasn't, they did, of course, execute an all-of-government crackdown in the United States on crypto. And now that it hasn't gone to zero, you're starting to see the doors crack open a little bit. For example, in August, the Fed announced, after in January saying essentially hell no never, the Fed announced in August, 7 months later, a novel activities supervision program. So that suggests to me that they understand that they didn't succeed in pushing it to zero. And it's not going away, and now they have to deal with it.
Wow. So they're changing their tune. They know that it's not going to zero. So now they got to find other ways to control it. Wow. What is this novel activity supervision? Could you tell us and our audience what exactly that means?
Yeah, good question. I'm not sure that anyone knows. In fact, actually, Custodia has had a very senior Fed official advising us, and some others who we've been talking to as well over the years, who informally. And one of the things that the senior Fed official advised us on is that announcement was unusual. Because typically when there is something like that comes out in terms of new supervisory guidance from a federal banking agency, the changes have already been made to what's called the supervision exam manual that the examiners have to use to examine a bank. And there is typically a list of names of people who are behind that, in other words, the experts that an examiner can call with questions. And neither of those two things happened in August. So it was an unusual announcement. No one really knows what it means, but they did admit, and I will give them credit for this, that they needed help, and that they were going to be working with the tech industry, the fintech industry, the bankers, and academics. I'm not sure how much the bankers could really help them, because the bankers don't have expertise in this area. A few academics do, but certainly the tech and fintech companies do. And it's nice that they acknowledge that they didn't have the expertise in-house, and would be reaching out. What that really means, was this just, paper, or is it serious? Time will tell.
Yes, time will tell. Custodia Bank, your bank, applied for a master account back in October 2020. Usually, I believe it takes about 3 to 5 business days or so.
5 to 7.
5 to 7, right?
Yeah.
Now, the Fed delayed processing it for more than 19 months. Is that correct?
Oh, more than that. It ultimately was, I think, 27 months, or give or take, before they made the decision to deny. Yeah.
And you proceeded legally to have that. Could you tell us about that, please?
Well, we were forced into it, and we did file suit. This is all public information, in June of 2022 for the delayed decision. And then ultimately, when the denial came down, which was coordinated between the White House, the Federal Reserve, and the Kansas City Federal Reserve Bank, all announced within, actually the White House and the Federal Reserve released announcements at the same time, 11:30 Eastern, and that's when the denial of Custodia's what's called membership application was denied by the Board of Governors, and the Kansas City Reserve Bank then, with military precision, 2.5 hours later, denied us the master account. So this was all coordinated. We knew it was all coordinated because there were leaks in the press, and we were just being hounded by the press in the days before that announcement. And in one case, we had multiple conversations with multiple reporters who were telling us what was happening. One actually did put it in email that there was that they understood that because they'd been told by insiders that everyone with a bank application pending at the Fed was simultaneously asked to withdraw their applications. And that could only have been done if it had been coordinated at high levels. And after the announcement happened and it was clear that it was coordinated, it wasn't just a coincidence, then with that weekend, we had the first insider come forward to tell us what happened. It was a political hit. And it was so interesting to learn the dynamics of the Biden White House. This has been subsequently confirmed by multiple insiders, and also it was an open secret in Washington, D.C. as well, that the financial services policy had been outsourced to Senator Warren, Elizabeth Warren, who has a veto, apparently, I'm told, I can't prove this, but has a veto over all financial services appointees in the Biden administration. And that she's got this anti-crypto army, and the person who was in charge of the crypto policy, who stepped into a power vacuum at the White House when the White House chief of staff was transitioning over, and the head of the National Economic Council, which runs economic policy, was transitioning over around that December-January timeframe. That person stepped into a power vacuum because the pro-crypto faction, several of them had left, and the anti-crypto faction was unopposed, and there wasn't anybody, at home who was going to stop that. And that's when the all of government crackdown on crypto began.
Oh, wow.
Allegedly.
Yeah. Well, wow. Admire you for your fight. How is that going on? If you could tell us the status of that. When do you expect resolution?
It's public information that we are in the discovery process now. The motion to dismiss was denied in June, and we have been in discovery, and discovery will end mid-December, and they've set a trial date for April.
Wow. Well, we wish you lots of luck, and I'm sure you will prevail. So thank you. And you're setting the precedents for everyone else and all other banks. So we're so grateful to you, Caitlin. It's people like you that make change, and you elevate society and humanity. So thank you so much for that. The master account. I want to go into that because that's what Custodia is designed to do, to minimize that settlement risk. It's
Correct.
with that master account that you can settle directly with the Fed and do it instantly and reduce the middleman fees, correct?
Correct. Well, it's more than fees. It's also the cost, but more importantly, it's the counterparty credit risk. A lot of folks woke up when Silicon Valley Bank failed and figured out, whoa, my bank deposit above $250,000 is an unsecured loan to a leveraged institution that has no insurance attached. And, some of the smartest people in the world, some of the Silicon Valley tech companies had kept all their cash at Silicon Valley Bank, and there was a scramble. And up until that point, my understanding is that the liquidity worst case scenario bank runs were assumed to happen over a 2-week period of time. But we saw Silicon Valley Bank collapse in 48 hours. And so it really is a perfect storm, unfortunately, for the banking system, especially the community and regional banks, because they're upside down, having bought a lot of longer term treasuries, playing what was the steep yield curve during COVID, when so much money got just shoved into the banking system. The plumbing of QE is that when the Fed expands its balance sheet, they're injecting reserves, to use an old phrase, into the banking system. Those reserves are cash on the balance sheets of the banks. And so when all this cash flooded the banking system during COVID, the banks didn't have demand to lend it out, or didn't think there were credit-worthy borrowers. And so what they did was just bought treasuries. But because the yield curve was so steep, they bought long-term treasuries. Okay, well, now the yield curve is inverted. Short-term interest rates are higher than long-term interest rates, not the other way around. And so the banks are sitting on large unrealized capital losses in the bond portfolio. And so they're actually insolvent. Now, the truth is the whole system is insolvent in and of itself. If it were ever a systemic run, again, this is one of the unfortunate big bang scenarios where if there's a systemic run, you'd see the Fed's balance sheet expanding by tens of trillions of dollars in a very short period of time. And what would that do to the confidence of the US dollar? Is that just a giant head fake because of a short squeeze? And you see a giant squeeze higher and then a sudden collapse. That's one potential scenario here. Again, go back and read what happened in the When Money Dies. You'll quickly realize that those kinds of things have happened in history before. I'm not saying that's going to happen here, but I'm saying it could, because the banks are in trouble, especially the smaller banks that are upside down on those bond portfolios. And we saw that at Silicon Valley Bank. They didn't have the capital to fill the balance sheet hole caused by the increase in long-term interest rates, and rates have gone up a lot since then, which tells you that there really is stress in the financial system, in the banking system. Like I said before, systems that are built with IOUs piled on top of IOUs, leveraged pyramids, they can unwind quickly. Now, that doesn't mean they will. Nothing I'm saying, by the way, is new. It's just that everybody seemingly woke up at the same time when they watched what happened with Silicon Valley Bank. And ever since then, there's been a bank walk, not a bank run, but a bank walk in the system, where folks have been taking their savings out that were earning no interest and putting them into money market mutual funds. So speaking back to Custodia decided to offer money market mutual funds for a very large brand name money market fund manager, government money market fund manager. Check our website. We're not licensed to do business in every state, but there's demand for the government money market funds because it's a quote unquote risk-free. I put those in air quotes, those words. It's a quote unquote risk-free because the government money market funds are restricted to investing only in US government paper, and it's short-term paper. So the yield on those money market funds, especially when you consider the counterparty credit risk, is more attractive than keeping money in banks. And we've seen it in aggregate that there's been this slow, steady bank withdrawal by folks of deposits from the banking system and purchase of government money market fund shares. It's almost every week you're seeing an increase in government money market fund shares outstanding and a decrease in deposits, especially in community and regional banks. And this is an issue, folks. I mean, I don't know how the Fed's going to deal with this. They do have a facility where they will pay par for those those long-term treasury bonds that the banks bought during COVID with all that excess cash, even though the market value of those treasuries might be only 60 or 70 cents on the dollar. The Fed will lend against those at par. Okay, so that facility definitely slowed down that bank walk, but it didn't stop it. And it's going to be interesting to see how the Fed handles this, because it's continuing to raise interest rates. And just today, we're recording this on October 3rd. We're seeing long-term interest rates, the 10-year and the 30-year interest rates, really increasing. Yesterday on CNBC, Rick Santelli did a technical analysis laying out the case that the 10-year Treasury could end up at 13% if you look at where the resistance levels are. Now, some folks don't agree with that technical approach, but it's one scenario, and a major media outlet is talking about it. if that kind of thing happens, then the solvency of the banking system becomes even more it becomes even under much greater pressure than it is today.
Absolutely. When the inverted yield curve becomes less inverted due to the long-term rates rising, that's not good. And I do foresee them probably going higher. The banking crisis is still going on. Just because it's not center stage, there's still that walk, like you said. Money is flowing into money markets, bills, short-term bills. Why not? Why not get 5-6% on your money instead of what? Pennies? On like JP Morgan Bank and regular checking account. I think there's been a trend with less banks, more branches. The smaller banks, the regional banks, they're going to have a lot of headwinds, not only with the mark-to-market losses, but also with commercial real estate. And that's held at the regional banks. So there is a lot of headwinds. I think that JP Morgan is just going to get bigger. It's unfortunate. That's right.
Absolutely. Yeah. Well, it's so interesting because here's the problem with the folks that are in charge of financial services policies we talked about earlier in the Custodia situation. They rail against the big banks and they rail against big business. And I think they want to believe that their policies are going to break up the banks, but the impact is actually the opposite. And so it causes me to question what they're saying.
Yes.
Because I don't think that they really believe it. If they did, they wouldn't be doing what they're doing, which is pushing the smaller banks into the hands of the bigger ones. And maybe their viewpoint is that if we have a European model where there are really only one or two big banks, that the government really effectively controls them. They're just arms of the government, and they'll always do the government's bidding. And maybe they won't lend against, they won't lend to a firearms dealer, or they won't lend to a gaming company, or they won't lend to an oil and gas company, because the smaller the number of banks and the larger the banks, the more under control of the government they are. So again, step back and don't necessarily listen to what they say. Watch what they're doing. Mm-hmm. What they're doing is actually making the big banks even bigger and more powerful.
Absolutely. Well said. Agree completely. With having a master account helps reduce counterparty risk. So important. And we stressed that earlier as well with that settlement risk and how Bitcoin solves this. But another very important point that I want to talk about is this fractional reserve system versus what Custodia has with full reserve banking. And I want you to talk about that, but I just want to make this clear point. Silvergate had 10 cents to the dollar, while I believe Custodia has $1.08 to the dollar. Yeah. Wow. Mm-hmm. Please tell us about this full versus fractional.
Yeah, and that was our proposal to the Fed, was that we would keep $1.08 in cash on deposit at the Fed for every dollar of deposits at Custodia. So there would be an extra 8 cents of loss absorption capacity deposited at the Fed. That was our proposal, and it was denied. Whereas to your point, it was Silvergate Bank. I don't know the numbers at Silicon Valley Bank, but it probably isn't that much off what you said. That Silvergate was sitting with 10 cents in cash against demand deposits. Wow. Custodia proposed to sit with $1.08 in cash against demand deposits. Big difference, right? And so when you start to think about the liquidity risk, it's not to say that bank runs couldn't happen at a full reserve Rothbardian bank. Of course they can, but the point is that the bank is designed to survive them and live to fight another day. And whereas what we've seen in the banks that failed or closed their doors, that in fact actually it was the bank runs took them down. Why? It was because of what you're just talking about. It's the borrow short-term and lend long-term, and do it on leverage business model. And that doesn't work in a world of online banking where folks can just wire out all of the money in their account within the span of minutes to another bank. Now, again, we talked about settlement risk. With FedWire, that's a real gross settlement system. So people who tried to get their money out of Silicon Valley Bank learned the difference between Fedwire settlement, which is same day, and ACH settlement, which is 1 to 3 days. Everybody was Fedwiring out their deposits from Silicon Valley Bank. But you see the point. You really can't take in a demand deposit that could be wired out in the span of a couple hours in its entirety, and take that demand deposit and make a 30-year mortgage loan against it. You can't. It's a fundamentally unstable business proposition. And that's a big challenge for the banking industry, because the traditional, banks on the corner. I live in a small town. Rural America is banked only by the small banks. And that's where credit is created. That's where a lot of the agricultural community gets their financing, is the small banks. And those banks are the ones that have been hit hardest by everything that's happened in the last year.
Well, take everything that we just discussed and let's fast forward 5, 10 years, maybe longer. What do you foresee with the banking system, and where do you think what's going to be the bank? Do you think if they're going to win and we're going to have JP Morgan, or do you think there's hope and we're going to have Custodia banks all around us?
Well, we will definitely have banks that specialize in digital assets. This is not going away, which is why Custodia took the punch. Obviously was hurt by it, but pivoted and got ourselves open. We're now operating. Check our website to see the states in which we're doing business for US dollar deposits, including Fedwire, and through a correspondent bank, and then money market fund deposits. And we are this close to offering Bitcoin custody. I certainly want to talk about that with your audience, because I know in your audience there will be a lot of people interested in that in the investment advisor segment. But let's come back to that in a moment. But those banks will survive. The question is, will the big banks essentially have such a cost of capital advantage and such regulatory capture that they're able to elbow the upstarts out? That clearly has happened so far, but we'll see. I mean, as we talked about the lawsuit that's in flight, when agencies don't adhere to the law, there are a couple of remedies, one of which is the court system, and that's the remedy that Custodia is pursuing. So stay tuned. But I think what we will see is a Fed with a far bigger balance sheet, because we will have gone through. Keep in mind that the balance sheet really doesn't shrink for sustained periods of time. It shrinks until something breaks, and then it expands again, the Fed's balance sheet. And so I think you're going to see a far bigger Fed balance sheet. You will see far fewer banks, because many will not make it through what the mark to market on their bond portfolios and their real estate portfolios, and they will get gobbled up by the big ones. And the regulators will, just like they did in the case of First Republic, make an exception against rules that prohibit the large banks from getting bigger, and they'll just keep getting bigger and bigger and bigger. So that's the way this is going to work. But that said, Bitcoin will be growing dramatically during that period of time as well. We will have gone through, you said, looking out a decade, we're going to go through 2 more halvings in the next decade. And those halvings make Bitcoin more and more scarce. And so more and more people, I think, will be coming into the ecosystem. More and more people will be running nodes as it becomes gradually easier and easier to run a node. The network is going to be more and more secure. The hash rate will continue to go higher, and the number of users will continue to go higher. So that's what will happen in the next 10 years. Just a lot of volatility, but Bitcoin generally trending up and to the right, and the Fed's balance sheet continuing to grow.
Well, there's hope, and that's why we wanted to hear it directly from you, because there is hope for the future, and nothing moves in a linear pattern. It always has its ups and downs, but we see the trajectory is on a steady upward incline. So absolutely. I want to go right into your services at Custodia Bank, which has to do with your custody, and it has a lot to do with Wyoming laws. Because I was going to say, many people might say, why Wyoming? But they have some great bailment laws. And I love this point. This is from your website, that I think it's from your website or one of your beautiful articles that says Wyoming law provides customers with clear legal title. And that's very
Correct.
important to digital assets. So at Custodia Bank, these digital assets remain with the customer, and
Correct.
you're just like a just custodian. You're just like holding them,
Correct.
but it's like a coat check or valet. Could you tell us exactly that process and what you do at Custodia with these digital
Yep.
assets?
Yeah, that is the legal structure. And it is important to give some historical context. Wyoming fought what was actually a de facto civil war in the United States over property rights.
Wow.
And it was the Johnson County Cattle War, which was fought over whether property owners had the right to fence out trespassers. And the property owners won. And that's the history of Wyoming. So the ethos here is very committed to property rights and to privacy. And so you can see how the stars align, that folks in Wyoming in the legislature really did understand all of this because of the cultural history of Wyoming. Now, with that in mind, you're right. There was, and I was part of the group that brought ideas to the legislature to help get these laws passed. The idea here is we don't have to do the old banking model, which was all these abstractions of the slow settlement speed for the monetary leg that we talked about earlier in the podcast. We can go back to the notion that a bank was just a safekeeper of property and that's it. And they would charge a fee for safekeeping the property. They're a service provider, not a counterparty. And what has evolved is that even in the crypto industry, among the service providers that provide exchange services or custody services or trading services, prime brokerage type services, all of those entities have been using the same model as the traditional financial system, which is let's pool everybody's assets into what's called an omnibus account. And what you own is a pro rata share of the omnibus account. Well, that's the way traditional banking works, and it makes everybody into a counterparty. Why don't we go back to the way it worked before traditional banking evolved that way and make the banks a mere service provider as opposed to a counterparty? And we can do that for digital assets. And that's your point about the bailment laws in Wyoming. They really are different. There are special bankruptcy protections that protect the customer. It is the most customer-friendly legal regime available for a digital asset custodian right now. And in the investment advisor community in particular, that matters because fiduciaries for their customers have to look for the most secure. They're using a reasonable person standard. So it's not always just the most secure and the cheapest, but they do have to do an independent review of the different alternatives that are out there and justify the choice that they made. It's a process requirement, not necessarily a guarantee of outcome, but it's a requirement that the fiduciary do their homework and ask all those questions. And so when you see somebody come to the market like Custodia, which is the first, I think, Wyoming Speedy Bank that will be offering digital asset custody. Kraken Bank is coming close on our heels as well. We both got our charters in the fall of 2020. It took us 3 years in both cases to get ourselves open with digital asset custody. And part of the reason is that both of us built our own custody platforms. And that takes time. We're not relying on third parties. A third party in the tech world is a security hole. And so you'd rather actually have that critical tech be built inside and controlled exclusively by you, so you don't have to worry about insecure integrations and connections. And we've seen a couple of companies fail for insecure integrations. Third party providers were attacked, and some Bitcoins were stolen. That just most recently happened at Fortress Trust in the last month. So long story short, we've done the best we can to adhere to the ethos of Bitcoin and to the clarity of property rights. Good fences make good neighbors.
Absolutely. Well said. So yeah, Wyoming, property rights oriented approach. Very unique, very different than most states, and certainly different than my state of New York. So we
Yes.
really
Yeah.
admire Wyoming for that. And thank you so much for that. So tell us about your customer base. Is it how is it worldwide? And which
Mm.
digital assets do you have custody?
Yeah. So the customer base is businesses only. That's what we're chartered for. We technically have the right to do customers with high account balances
Mm-hmm.
as well, but we're not set up yet to do individuals. So we're serving business entities only. It has
Right.
to be a
Okay.
bona fide business, but it could be an investment business, a multi-member LLC, for example.
LLC.
And
Great.
again, check certain states. We're only operating in certain states. But the point is, as I mentioned earlier, US dollar banking and government money market fund services for a brand name, very large asset manager, and Bitcoin custody with the benefits of Wyoming law. We have the ability in our business plan to do a couple of additional things. One is to provide custody services for Ethereum, which we've not built yet, and also a stablecoin. We thought that the puck was going to go where it clearly will go, which is that stablecoin issuers have to be federally regulated banks. The federal bank regulators, as we talked about earlier, have rejected that, but it is moving in that direction now. It will either be done through the court system or through Congress passing stablecoin legislation. There's a pretty high probability that one of those two things occurs. What's interesting is that Custodia was granted the patent for a bank issued US dollar stablecoin on a public permissionless blockchain in July of 2022. So right now, the federal banking regulators are blocking banks from doing that, from issuing their own stablecoins. But it does look like that something's going to happen. There's a decent chance it happens, depending upon what happens in Washington, D.C., which is, of course, just heading for crazy season. But there are a few more months left before crazy season when something might get done. And there is a bipartisan effort supported by very senior people on Capitol Hill and potentially the White House to get stablecoin legislation passed. And so we're hanging around the hoop on that with that patent, which we took the time to get, and we're not using at the moment because of the regulatory system, but that the regulatory regime does appear that it is going to be changing.
Absolutely. Congrats on that. You know, it's just a matter of time. You just got to keep up the fight.
Yeah.
And then all of a sudden, it'll all happen all at once. Amazing stuff that you're doing over there in Wyoming. Now, the Fed also denied Custodia Bank's application to become a member of the Federal Reserve
Correct.
System. Can you tell us
Yes.
about that?
We had two applications in. The first one was a master account application. That was the one where the application said 5 to 7 day business turnaround. It was a one-page application because historically there just hadn't been any question whether a validly chartered bank chartered by one of the U.S. states was going to get a master account. And the Fed voted itself in the last few years something that Congress didn't give it, which is the right to overrule state chartering authorities' decisions, and that was that is not in the statute. So that is now at question in multiple lawsuits. There are 3 currently pending, and my understanding is that more are coming on that very statutory question. So that is one of that's the master account. Custodia went ahead and applied. We actually got back channel guidance that it would be helpful if we applied to become a Fed member bank. What does that mean? It means we would be regulated by the Fed itself. And so we did seek that. There was incredibly disparate treatment of Custodia in the membership application process. I'm going to leave it at that. We did disclose on our website some of that incredibly disparate treatment. Not all of it has been disclosed, but stay tuned because something very unusual happened in Custodia's membership application, and we're fighting it.
Wow, definitely stay tuned on that. It seems that the concern is not that they're banning banks, but they're actually what they're trying to do is cut off those on and off ramps. Is that what you're witnessing with that?
Correct. Yes, it is. And it's interesting, and going back to Lynn Alden's book, Broken Money, she talks about that as being the real threat. It's the real threat is not trying to ban crypto. Some governments have tried to do that, but that's like banning speech. You can't ban the use of code. I mean, you can try, right? But you're not going to have an effective ban. It's like Napster, right? You're not, and Tor. You can't ban those things. What you can do is either create carrots, which is reasons for people to do business in the regulated lit portions of the markets as opposed to the dark net portions. But you'll never be able to ban the dark net. This is why Bitcoin is so powerful. It will never be banned as a peer-to-peer network. But most folks will want to only do business with regulated entities. That's just the way it's likely to be. And so I think that's why one of the reasons I scratch my head at the policy, because we're trying to push everything into the shadows. And again, the only way that made sense is that they thought they could push it to zero. And once they realized that didn't work and it didn't go to zero, now I think you'll probably see a sea change. It might take a change of administration in order for that to happen. We'll see. But the policy of pushing it into the shadows is just making it harder and harder for regulators to deal with it because they can't see it and they don't know where it's going to pop up. It just came out this past week that a tiny Kansas bank that failed about 6 weeks ago, the reason for the failure was that the CEO fell victim to a crypto fraud scheme involving an overseas entity. And there was a big hole in the bank's solvency as a result of that, right? I mean, if you're not actually regulating the provision of these services, the regulators can't see it, and then they deal with the whack-a-mole kinds of outcomes like that. So I think it's coming. That's where it'll end up.
Absolutely. If they can't just stop it. So they make it increasingly more difficult to do every step of the way, and they just try to wear people out. That's why we support you and we all fight together to make change, and it will happen. It's just a matter of time. What are your thoughts on the Bitcoin ETFs nowadays? There's always some news here every other day, BlackRock and this and that. You think it's coming, or what are your thoughts on that?
No, I don't think it's coming during the Biden administration. I think it's going to have to be a changeover in administration because Gary Gensler is just vehemently opposed to it. And again, remember the powers that be in Washington who are in control of financial services appointments within the Biden administration, I'm told, are the anti-crypto army, right? So that explains a lot about how Gary Gensler went from seemingly supporting this technology to being so vehemently opposed to it, because the people pulling the puppet strings behind the scenes are vehemently opposed to it. And those folks are where the power base is, and they control things like political appointments.
Great. I agree. I think we're going to have some type of change in the White House there, because Biden's all of government crackdown on everything crypto it's just been unreal. So thank you for those excellent points there. What about CBDCs? I just want to get your opinion on them. A lot of talk about them. They're coming, they're not coming. And what do you think?
Well, they're already here in a number of countries in the world. And I think they were the greatest advertisement for Bitcoin. Objectively, look at what happened in Nigeria. Bitcoin use went up substantially when the CBDC was unveiled because nobody wanted the government surveillance coin. But yet it forced
government
people
surveillance. That's it.
Right. But it forced people to learn how to deal with digital wallets and digital money. And, it was a great advertisement for Bitcoin. So, I mean, yeah, that is a hill I'm willing to die on. I've said that before, that government surveillance money is concentrating way too much power into the hands of people who have historically proven that they are willing to abuse it. And it has been more the Democratic Party that has done so with Operation Choke Point 1 and 2.0, but I would not put it past the Republicans either. There are some authoritarian impulses in both political parties, and you put that much power in somebody's hands, they're going to abuse it. If not in the beginning, it will eventually evolve that way. And I think a lot of Americans have their heckles up about this. That said, there was this debate over whether FedNow was a CBDC. It's not. But where they're going and where they're not wrong is that to the extent that the real-time gross settlement system at the Fed, which is currently FedWire and then now FedNow is being rolled out, the Fed technically has the ability to reject payments. And so it hasn't been abused yet, but it's a lot easier to reject payments under the new systems than it is under the old legacy FedWire system, which is a pretty old technology. So everybody should keep their eyes wide open. And this is where I definitely would refute the notion that FedNow is a CBDC. It is not. But where folks are going, it's kind of like the analogy where I just was reading a story today about the opinion poll that Biden is too old. That's not really what they're saying when they say he's too old. They're saying that he doesn't have the cognitive abilities. There are a lot of spry 90 and 100-year-olds. He's only 80, but it does appear that he's not worked in 18-hour days like one would expect of a US president, to say it nicely. And I think that analogy is apt here with FedNow as well. Folks what they're really against is not these modern technologies. What they're against is government surveillance coin. And so what we need to do is keep our eyes and ears open on FedNow. If we start to hear that FedNow transactions are being rejected for political reasons, then I think there will be an uproar. To be clear, we have not heard that yet, but that is where I think the folks who are critical of FedNow are not wrong. Their heckles are up about just the new manifestation of Operation Choke Point, that certain politically incorrect individuals and businesses and maybe entire industries may come under target and lose their banking services. And I leave my politics out of it. I do not believe banking should be politicized. We should fight those fights out in state houses and in Congress, not in the banking system. And I'm not afraid to stand up and say that. I leave my own personal politics out of it. There will be businesses, I'm sure, that Custodia will bank over time that I don't personally align with politically. But that's the point. The banking system should not be politicized.
Well said. Absolutely agree with that. A lot of things shouldn't be politicized, and they always try to drag the politics into it with the markets, trading, investing, business, everything. So in banking as well. This has been so amazing. I mean, that's the whole point of this podcast, is to educate, to make people aware. And like you said, people should just keep their eyes open with everything that's going on. And we want to follow you and stay tuned with all of the latest with Custodia Bank. So please tell our audience, Caitlin, how they can follow you and stay up to date on Custodia Bank's massive growth that is incoming.
Thank you. CustodiaBank.com. Get in touch with us, info@custodiabank.com. You can take a look at our doing business as hyperlink on our website for an updated map of states where Custodia is licensed to do business. And stay tuned. We're a tortoise, not a hare. We're being very, very careful to ensure that we don't do anything wrong, and that we can keep this durable banking service open to an industry that obviously is in need of it. So I thank everybody for their support. A lot of folks often ask me, how can we support you in the fight? The answer is do business with Custodia. If we're licensed to do business where you are, and if you pass our customer onboarding requirements, then step up and support us by doing business with us. I have to give a disclaimer. Our deposits are not FDIC insured. We are a 100% reserved non-lending bank, a Rothbardian bank, some folks would call us. And so beware of that. And obviously look at all the disclaimers on our website.
Well, absolutely.
Thanks so much.
Thank you. I know, risk aware with full banking like that. To me, that's being very risk aware. And I love your website. I have to say, for everyone, please visit it. I love the knight. Okay, the knight is the best piece on the chessboard, and you have chess on there. We're a chess family. So I love that. It's so dear to me, and it just symbolizes the strategic long-term mindset. and you win battles slowly and strategically, and you will prevail. We love you, Caitlin Long. You're making a difference, and thank you so much for everything you do.
Thanks so much.